Hello everyone!
Hello!
And welcome to this quarterly video of TSP Funds. The third quarter was a difficult period where most asset classes were in negative territory. Investors were especially concerned by the scenario of higher for longer rates, the Chinese housing sector weakness, and indications that global economic data is turning down. In detail, developed and Asian equities recorded negative performance, both losing more than 3%. Chinese market fell by 1.9%, held by the policy support to real estate sector. And finally, Thai set limited quarterly losses to 1.4% despite a noticeable correction in September. On the FX market, the US dollar appreciated significantly versus most currencies on the back of a resilient US economy and a sharp rise in US yield. In particular, Thai baht lost 2.7% against the green bill. On fixed income, rates were sent up to multi-year high around the globe, especially in the US where the Fed kept a hawkish stance and signaled a prolonged period of high policy rates. As a result, global aggregate index and credit market lost respectively 1.8 and 1.6% over the quarter. In Thailand, yields also went up amid the global rate backdrop and the incoming fiscal measures which could fuel inflation next year. Overall, both government bonds and credit ended on a negative note.
In the third quarter, TSP funds recorded a negative performance, dragged down by the correction of foreign equities and global bonds. In relative terms, portfolios ended the quarter a bit behind their benchmark. Over the period, the fund selection within Asian equities and the positioning on global bonds were the main detractors. On the positive side, the outperformance of Thai and developed equity funds contributed to the relative performance.
Looking forward, we expect a deteriorating outlook and we see four themes to monitor. First one, a slower economic growth. In the US, we continue to expect a shallow recession as the US consumption is now showing signs of weakness and the impact of tighter financing conditions should outpace fiscal measures. Secondly, inflation will guide monetary policies. The inflation trend will decelerate, but recent energy prices spikes add some uncertainty. We don't expect oil price to sustainably overshoot, but a prolonged rise may give central banks an argument to keep rates higher for longer. Chinese growth and immense fragmentation is the third theme. Housing sector in China remains a major concern, and Chinese lower growth could affect other emerging countries. However, some areas are relatively insulated and overall the EM versus DM growth differential will remain largely in favor of emerging markets. Lastly, geopolitical and political hotspots to monitor. On the geopolitical side, Russia-Ukraine, US-China relations will continue to take center scene. On the political front, the US shutdown issue has only been delayed and it will be back on the table in November. On financial markets, we believe risky assets valuation remain fragile and don't reflect yet the growth deterioration we anticipate in the coming months. In this context, we maintain a defensive positioning on equities. On developed countries, after a resilient company result in the first semester, we expect some weaknesses in forward earnings. In China, where we are around neutrality, volatility is likely to remain elevated, as markets are balanced between housing market difficulties and political support. Finally, we have a balanced view on Thailand. Overall, this difficult environment leads us to favor quality companies with resilient business model. On fixed income, we have a slight preference for global versus local bonds as global yields are at attractive levels from an absolute and an historical standpoint. On global fixed income, we have a slight positive bias on duration and we continue to favor US bonds. We prefer government bonds versus global credit, but we acknowledge credit investment grade displays resilient fundamentals and a decent yield. Finally, we maintain our diversification to emerging market local debt, which offers a strong carry and robust economic prospects. On Thai bonds, we have a tilt towards mid-term aggregate bonds rather than short-term. While BOT unexpectedly raised its policy rate in September, The normalization process should be finalized now.
Considering the deteriorating outlook, we maintain a defensive positioning along the quarter, but we implemented some adjustments in portfolio strategy. On the equity side, in July, we decided to expand diversification to broad emerging markets by investing on Schroder Global Emerging Market Opportunities. Looking forward, despite concerns over China, emerging countries display improving growth prospects. Finally, valuations are attractive, and earning growth also paints an interesting picture for the medium term. In September, we introduced Goldman Sachs India Equity, as the country is enjoying a strong growth momentum supported by the economic policy. From a geopolitical perspective, India keeps on benefiting from US-China tension and has become strategically important. Finally, in terms of portfolio construction, such position brings an interesting diversification to the portfolio, as India is quite decorrelated to other emerging markets, and especially China. We financed those two purchases by trimming Schroder Emerging Asia and Schroder Asian Equity Yield, and by selling Schroder China Opportunities. As a result, our allocation to China turns toward neutrality. On the global fixed income side, we continue to reinforce sovereign bond exposure and increase duration in July by consolidating our position of iShares Global Government Bond ETF. At current level, valuations are in favor of government bonds. In September, we introduced Amundi Fund Global Corporate Bond, hence reinforcing a bit the exposure to credit investment grade. While we remain around neutral on global credit, we acknowledge the asset class offers resilient fundamentals and an attractive carry, and is supported by a strong demand from investors. We financed this purchase by trimming the exposure of Wellington Global Bond, an aggregate bond fund. To conclude, at this stage, we confirm our cautious positioning and a further diversified allocation. However, we aim to remain active and continue to explore opportunities across the globe. Please always keep in mind the mid to long-term horizon of an investment on financial markets. TSP funds allows you to diversify your savings and gain access to the best experts. These are the key drivers for long-term performance. We thank you for your support and attention.
Thank you.
And we will meet you again for the next quarterly video of TSP Portfolios.
TMB และธนาชาติเปลี่ยนเป็น TTB เปลี่ยนเพื่อให้ชีวิตคุณดีขึ้น